Crude taking a leg lower after President Trump called on Saudi Arabia and OPEC to lower prices at the World Economic Forum earlier today. For more on energy policy and Trump 2.0, let's bring in Paul Sankey of Sankey Research. Paul, great to have you with us. It's interesting to hear President Trump, and, we had Joe Livornia on before, who, would identify with President Trump in terms of policies, I believe, that lower oil prices are very, very important. When under the Trump administration, it is almost taken for granted that he will be harder on sanctions when it comes to places like Iran and Venezuela, and that would mean higher prices ultimately. That Canadian tariffs would mean higher prices ultimately. You think oil prices will go higher? What are the drivers in your view?
Well, I think, as of about Labor Day last year, we got concerned about the oil market, and the obvious problem was China. And in fact, 2024 ended with China recording its first negative year for oil demand growth, really for the first time in 25 years, and certainly its first ever negative as a material oil market. China having been responsible for 50% of the world's oil demand growth over the past 25 years. So a very big deal with China going negative. And at the same time, Russia, as you know, and Iran particularly, continued to smuggle a lot of oil to India and China, which was effectively taking Saudi's market share. So that was the setup into the back end of the year. And what was required was for Saudi to hold the market together, which by the end of the year it was, and we found ourselves in equilibrium. What was the big surprise was that the Biden administration then put tough sanctions on Iran and on Russia back to back, and that wasn't expected as, the kind of final move, especially as it really seems to have played into Trump's hands in many ways. So Trump is now in a relatively strong negotiating position against Iran and Russia, and both those situations seem likely to continue through the first half of the year. And then the other big thing that we got, obviously, was cold winter. So when you put that sudden change in the supply dynamics together with the cold winter, suddenly the first half of the year looks good for oil. We're tentative about it because there is still spare capacity, particularly in Saudi. But, nevertheless, I think the market looks a lot better than it did 6 months ago.
Paul, what are the roadblocks for these big cap integrated names? If you hear Tim, we talk about it all the time. Their balance sheets are the best they've ever been. If you look at them, they're more productive, they're more efficient than they've ever been. They've been forced to be that, yet the valuations are ridiculously low, and the stocks can't get out of their own way. I mean, what's going to be the catalyst, if any, to get them higher?
Well, look, these guys are running themselves well, right? They're operating well. They're doing the right thing. They have good balance sheets, as you mentioned. They're returning cash to shareholders, and we just don't get any multiple expansion. And I think we're not going to, quite frankly, simply because the market will continue to discount the end of the oil age. Even if it never comes, it'll always be a concern. And, the latest mega theme, obviously, is AI and all that's doing for the natural gas market of the future. So you can get multiple expansion amongst the natural gas names. But for the big oils, they're really going to trade as yield instruments. And at the moment, it's a decent yield that you're getting out of them, particularly if oil holds 80. You're going to get towards a 4% type dividend plus, a 4% plus type buyback. So you're in the 8% return range. But that's about as good as it's going to get, unfortunately, unless we see sustained higher oil prices than the sort of 70 to 80 range.
It's Karen. Thanks for being on. So one of the one of his 333 is an additional 3 million barrels of oil a day. Do you see that happening? Do you think the oil companies will push back on that? How do you see that playing out?
Well, my initial reaction was that he just needed a third 3, and so he made one up, which was let's increase oil production. But in fact, he said, I think it was oil and gas, or was it energy production by 3 million barrels of oil equivalent a day. And the fact that he used barrels of oil equivalent, effectively a calorific measure, means that he can add electricity, he can add natural gas, he can add coal, and he can say that they made the target. So, is it meaningful? It really relates as well to drill, baby, drill, which we're really struggling to find how you can make drill, baby, drill work, other than some sort of additional subsidy to the oil companies, which I doubt you're going to get. So drill, baby, drill has also been a bit of a mystery. The biggest wild card, though, I think, Karen, has actually been the Canadian tariffs. I mean, that one, we expect trouble in Russia, we expect trouble in Iran. Sure, we expect issues around Saudi, and maybe problems in China, but problems in Canada was not on our bingo list. And that again is a huge head scratcher because, of course, if you do increase Canadian prices by 25%, which is what the tariff would effectively do, you're going to have a huge potential upside in prices within the U.S. as you scramble to recover those barrels. But the companies are still unlikely to want to drill into that very volatile change in the rules, So drill, baby, drill, and the 3 million barrels a day, I don't know how you get them.